So a little bit late tonight. Normally go out at 7, and it's just gone 8:30 in the evening in the UK. So I'm Ian Smith, I'm the Strategy Smith. We've been going through financial health of businesses, ratios that you can apply by dissecting profit and loss, balance sheet, and cash flow to be able to determine the profitability, the liquidity, solvency, and tonight we're going to cover asset management as to how a business can employ its assets efficiently. And we're going to dissect both the assets on the balance sheet and we're going to cover some elements from the loss as well. So this is going out on LinkedIn, TikTok, YouTube, Facebook, and X. So it's across 5 platforms. Please like and subscribe and comment if you have questions or comment anyway. I get back to all of the people who comment, but I might not see them live because I'm going across the 5 platforms. So what I'm going to do is we covered solvency last time. And solvency is how a business is geared in terms of how it's financed via debt or equity or essentially both. We've covered the balance sheet and ensuring that total assets equals total liabilities plus shareholders' equity. And we went through all of the gearing and leverage ratios to see how a business is financed. But also we dipped into some of the elements from the balance sheet to understand how it's built in terms of its profit compared to the interest it's paying on its debt. So there's a crossover between profitability and solvency and how the business is geared in order to finance its assets through debt and equity. So what I'm going to do is I'm going to keep the assets on this side of the board. I'm going to get rid of the shareholders' equity and liabilities. I'm going to put a profit and loss sample on this side of the board. I'm going to take off these ratios and we're going to go through some of the activity ratios for asset management to determine how well a company employs its assets. So we'll just clear the board and then I'll describe some of the elements where we're able to look at profit and loss as well as the balance sheet when you're looking at a business's financial health. So right now we've just got assets on one side. I'm going to clean this a little bit better. Kind of like Tony Hart, this. Cool, there we go. And then below here, we're going to draw the asset management ratios. So we've got current assets on this side because this is about asset management and activity ratios. And I'm going to put profit and loss on this side. So in profit and loss, you've got sales. You've got cost of sales. In brackets because it's going to be negative. You've then got gross profit. You then have expenses, or sometimes called as sell general admin or SG&A. So we'll put expenses here, or SG&A. Oops. There we go. That's F&B there. I'll draw it properly. So, general and admin, cool. Then you will have EBITDA. And then after EBITDA, you've got depreciation, which is another minus. We're going to touch on why depreciation is important when we look at net assets as well. Then you have EBIT. Oops. Then the bank gets theirs, so you get interest. And then you've got profit before tax. Then HMRC or IRS, if you're in the US, they get theirs. So then you've got tax. And then you've got profit after tax, or PAT. Okay. So we're going to look at some ratios that calculate, we'll just put P&L, balance sheet, assets, that calculate net sales. Now, when I talk about net sales, in some profit and loss statements, you need to deduct allowances and discounts, but also returns as well. Now, when I talk about net credit sales, which I'll come on to in a second, if you can identify cash sales within the profit and loss, then you need to deduct cash sales from your net credit sales as well. And I'll describe what that means in a second. But the first activity ratio looks at the total asset turnover. And what that means is it's determining how, or it determines how net sales compares to the total amount of assets. And the reason why that's important is because you're able to understand what these assets are delivering in terms of sales. And it should be a good indication as to the financial health of the business, because if it employs more assets than sales, for example, then you can question things like profitability, liquidity, and also how the business is leveraged in terms of debt and equity. So it's a good activity ratio. So we'll look at net sales over total assets. And again, you'll be able to Google these, you'll be able to understand what a total asset turnover ratio should be for your industry. So you calculate net sales through sales minus the any returns, any allowances, or not returns, allowances, but also any discounts as well. So it gives you the net sales compared to the total assets. And that gives you the total asset turnover. Now, it's useful to examine turnover ratios for each type of asset, such as receivables. Now, what this determines is how long it takes for the business to get paid. So when we looked at gearing and we looked at the time it takes for the business to pay its creditors, this is about how quickly the business gets paid from its debtors, so receivables. And the reason why we looked at that in terms of finance for the business is if the business is taking a long time to pay its creditors, then it's dependent upon the creditors to finance the business, because it's in terms of the balance sheet, although it's a short-term liability, it's still a method of financing the assets within the company. So in contrast, the reason why it's important to look at this ratio is if, for example, the business is heavily dependent upon the debt that it's getting from its creditors, from its suppliers, we need to ensure that it's receiving cash from its debtors in good time in order to satisfy the short-term liabilities. Hence, the crossover between a little bit of liquidity, solvency, and also asset management as well. Now, we need to look here in terms of the receivables, how that compares to the net credit sales. You should be able to highlight this in the P&L, because in the P&L, you'll be able to see which transactions came through from cash and which came through on credit. And the reason why that's important is, again, you're able to deduct the cash sales, any allowances or discounts, and any returns from the gross sales, which what's left over will be the sales that are on credit. So what we need to do is determine how much net credit sales are made each day. The way that we get to that, I am going to be able to speak by the time we finish the video. Just bear with me. So the reason why we need to look at net credit sales is to determine how much sales are issued on credit per day. So we'll look at the sales first, and we're going to minus cash sales. We're going to minus any discounts or returns, or both if they're allocated on the P&L. Discounts minus returns, and that equals the net credit sales. Now we need to take the net credit sales and divide that by 365. Then that determines how much sales are issued per day on credit. Now we need to look at the receivables, because we know how much sales are issued per day on credit, and we know how much receivables have been allocated as current assets in the balance sheet. So now we need to take accounts receivables over credit sales per day. So that tells us how many days it takes to receive the receivables. So we take this number, and then we take accounts receivable, and we divide that by net credit sales per day. Okay. And then that will tell us how long it takes for the business to receive in days its receivables. That's quite a good indication, not just as to how well it's leveraging its assets, how well this activity is being utilized within the business. Also gives an indication of liquidity as well, because if it's not getting money in quick enough, then it can put into question how quickly it can satisfy short-term liabilities. And that's quite a good ratio to look at in terms of asset management. Now, there's another ratio that you can look at, and it looks at the inventory. Now, the inventory, because it hasn't been converted into a product that has a value, it's allocated in the balance sheet at cost. And so what we need to look at when we look at both P&L and balance sheet is the cost of goods sold. So we'll call this COGS. And it's important to allocate cost of goods sold in this case because of inventory being allocated at cost. Now, in some cases, cost of sales could have people in it, for example, and so it might give an inaccurate reading of cost of goods sold over inventory. And what this means is how much of the cost of goods sold is converted into inventory. Now, this ratio is quite simple, but you just need to know where to find the bits of information from and how to allocate them correctly. So if you have cost of sales, which may have people's salaries and things like that included within it because they're attributable to sales, try and take out cost of goods sold and allocate it correctly to be able to measure cost of goods sold over inventory. You should have a ratio between 5 and 10. That'll give you a good indication as to how much cost of goods sold compared to the inventory is in the business. So, for example, if you have 5 million cost of goods sold and 1 million's worth of inventory in your current assets, then that's quite good because you're able to convert 5 million worth of your costs into 1 million of inventory. Now, if you're able to convert more than that, for example, into finished goods and how much you need to hold in your business and things like that, then it shouldn't really be more than 10 because you've got excess inventory that you haven't yet converted into finished goods. And don't forget the inventory is taken at cost, which is why you need to look at cost of goods sold. So that's an inventory turnover ratio, is how quickly you can turn over your inventory. Another good way to look at asset management and how you can leverage, not talking about gearing or leverage again, but how your fixed assets are being utilised to the success of the business. So if you have property, if you have plant and equipment more specifically, this highlights how a business can transform its plant and equipment as an asset into sales. So this is where depreciation comes in, because we need to look at the net sales. So again, looking at sales minus discounts and returns. You can include cash sales in net sales in this case, because it's not net credit sales, it's net sales. Net sales over net fixed assets. Now, this is where a little bit more of the strategy and tactics come into play. If you're a builder, if you're a manufacturing business, if you're an asset-intensive, physical asset-intensive business, as to how you can optimize the asset management of those physical assets to give you a better balance sheet, but also give you a better fixed asset turnover. Because if you're able to leverage those fixed assets and optimize their maintenance, optimize their value, and take into account depreciation, it should give you a better fixed assets ratio compared to net sales. So you're able to more proficiently and efficiently leverage your plant and equipment for your net sales. So that takes into account net sales, but don't forget in the P&L you have depreciation. So you need to take fixed assets minus accumulated depreciation. So you'll have a gross block, perhaps, within your statements, and you'll be able to deduct accumulated depreciation from your fixed assets, which then gives you your net fixed assets. So that ratio, make sure we can fit everything in, is net sales over net fixed assets. And you can still see all of that. Awesome. So the sales returns, you need to take away any allowances and discounts and things to give you the net sales. And then net fixed assets, you take away accumulated depreciation. So now we've covered profitability, we've covered liquidity and the balance sheet, We've covered debt and equity gearing or leverage, solvency in the balance sheet as well. We dove a little bit deeper into liabilities for the balance sheet. And now we've crossed over looking at asset utilization ratios or activity ratios, looking at both P&L and the current assets within the balance sheet. So if you're adopting a strategy to grow your business and you want to increase the financial health of your business, then to give you a story would be, as part of your business planning, you can look at best practice within the industry and learn from potential competitors, learn from market leaders to understand what their ratios are in terms of profitability, liquidity, asset management, and solvency, or gearing, in terms of debt to equity gearing. But if you're making changes in your business to increase sales, think about how that will optimize your liquidity. Think about how it will optimize your profitability. And think about how it might optimize how you're able to finance your business through debt and equity, and how that compares to how you're financing your assets. And think about things like, if you're making capital investments into fixed assets, how that will convert into more net sales. So how can you more efficiently leverage those plant and equipment or property into net sales or income? So there's one story. So if you think of increasing sales, optimizing cost, increasing gross profit, optimizing expenses, and increasing EBITDA, and what's left is the firm's profit to run the business. That's from there down the going concern of the business. You've got to depreciate your assets, then the bank gets theirs, government gets theirs, and what's left is for the shareholders. So if you want to increase that pot, shareholders' equity or profit after tax, retained cash, then how can you reinvest that into the business to optimize P&L, to increase your liquidity? You might want to retire some debt, and therefore your assets will go down, but your debt will go down as well, because you might have debt that you've retired through current assets, or you might have some long-term investments that you've allocated that are paying you back in terms of interest and payments and things like that. But then, how can you look at your gearing to lower the risk in the business? How can you ensure that the business is sufficiently liquid to be able to retire short-term liabilities? And how can you leverage your assets within the company to increase sales, to enhance profitability? How can you look at your total assets over your net sales and look at the utilization ratio, etc., etc. So when you're able to look at the statements that tell the story, financial story of the business, you're actually able to make quite strategic decisions based on the operations of the company, based on how you market the business, based on the mission and objectives of the business, and how you can see the end goal in sight. And this is how other companies will look at your business if, for example, you want to sell. So you can think about these things in terms of exit strategies. What does good look like for a business that's ready to sell in your industry? It has strong liquidity. It's balanced in terms of its gearing, in terms of cash in the business and debt financing. It's proven through its operations that it's utilising its assets for the success of the company. It has a well-balanced cost to inventory ratio, and someone wanting to buy the business can see it and see the plan moving forward in terms of forecasted future cash flows and predictability of future cash flows, a small discount rate because you thought about how gearing, the cost of debt and the cost of equity is taken into account for the discount factor. And so that business plan is starting to look very strong, whether you want to grow the business, to grow it exponentially, or whether you want to grow to sell, or whether someone's approached you to buy the company. I would advise that you do what's called vendor due diligence, or ask someone to support you with it to see where you're at in these ratios: profitability, liquidity, solvency, debt and equity gearing, and asset management. So we've hopefully made it fun. The dissection of balance sheet, profit and loss. I'm going to do a little bit on cash flow as well. And there's not too much in terms of ratios you can look at from cash flow, but the cash flow statement is a beautiful thing when you're able to read it in contrast to these things. So we've gone through all of the financial health checks, looking at the balance sheet and the profit and loss. The cash flow statement, we're able to look at other things to determine the financial health of the business as well. And again, forecasted future cash flows, the predictability of those is what's very important for a company. So if you're able to, for example, sign big contracts over a few years, you've got predictability of future cash flows. If you've got historic performance of the business, that's not predictability of future cash flows, depending on the industry that you're in. And that's when you need to think about how the business is financially healthy when you're putting value on it. So I think that's everything that we've covered for financial health. By all means, send me some questions, and I'll be happy to support you with it. I've started putting my email on the website. So if you go to www.TheStrategySmith.com, my email, ian@TheStrategySmith.com, is right at the top. You can email me, send me some questions, inquiries, things like that. Check out the Strategy Smith Academy as well. And you can WhatsApp me through my website as well. And I'm sure you'll be able to find my mobile number on my LinkedIn profile. So don't forget to like, subscribe, follow and comment, and I will see you all later this week.